So we now know how to enter our trades and how to place our stop losses. The next part, and the important part, is how to manage our profits, how to take profits. This is an area that most people do not know how to do. Our main concern is that we do not let winners turn into losers. That's what happens to so many traders. And in fact, the biggest losses will tend to be those that have already made profits. People get greedy and they fail to take their profits when they are on offer. So what we do is we take partial profits early on and then we protect what we've already made. And that gives us two bites of the cherry and the best of both worlds. We then adjust our initial stop loss once we've taken our first profit. And when we adjust that stop loss, that initial stop loss, what happens is we ring fence the entire position to make sure that we can't make a loss on the trade. As the stock continues to move in the direction what we want it to, we would then use what's called a trend line to ride the remainder for as long as possible for hopefully a windfall profit. And when the markets do trend, that's where we make massive profits very quickly. And the best traders in the world trade the trends just like we do. So let's have a look and see how we would take our profits. Well, first of all, what we need to do is we need to set a logical target that's sensible in the context of the markets. Now, in trading, there is a concept called the one-to-one or equal drive pattern, and it goes a bit like this. Just say the stock goes up by $3 and then makes a retracement, or forms a flag for that matter. The one-to-one theory suggests that this stock will move up another 3 points. Now, of course, that's not going to happen in real life, but it's just a concept, and it's used often in intraday trading of the indices. Similarly, if a stock is going to go down, let's say it went down by 3 points, it then retraces or forms a bear flag, and then supposedly, under one-to-one theory, it would go down another $3. Now, if only life were that easy, of course, it doesn't always do that. In fact, it rarely does that. But what we can do is we can utilize this theory and make our own changes to it to set some simple profit targets, some easy profit targets, and ones that have a high probability that will hit, and so we can take that first profit. So, although we're not going to use one-to-one, let's just do a recap of it, just so that you know what it's all about, and then I'm going to show you where we're going to head with it. It's common in intraday technical trading of index futures. So when people are trading the Dow and the S&P futures, people can use these levels, and the roots of it are based in Elliott theory, which I don't really subscribe to, and also Fibonacci and Gann levels. But in terms of practical use of one-to-one, I think that it's really not very useful for us. So what I do is I make a different version of it, a much more conservative version of it that has a huge probability of making sure that our first profit targets are hit. So what we do is we take our partial profits well before that one-to-one. So here's what we do. We can take our profits at not the one-to-one level, but at 0.382 or 38.2% of that, or say at 50% of that. Now, the more conservative target would be 38.2%. So here's what we mean. Here we've got a move up $4, and it's then forming a bull flag for the sake of argument. As the stock breaks out, what we're going to aim for is not another 4 points, but say another 2 points. So that would be going for 50% of that one-to-one target. Or what we could do is set a more conservative profit target, which I now prefer, particularly in the markets in which we're currently operating, of 38.2%, which would be $1.50. And hopefully as the stock breaks out, our trade is entered, and then our first profit target clearly has more probability of being hit than our second. And hopefully then we can ride the rest with a trend line, which I'll go into a bit later. So similarly, we have a stock that's moved down by $4. It forms a bear flag. We can set our profit target at $2, which would be 50% of that one-to-one, or more conservatively and more probability of success, we can set it at 38.2% extension of that initial $4 move, which would mean $1.50. And that's got a far better chance of working out. So we can take our first profit, we can adjust our stop loss, and therefore ride the profits thereafter. So we'll see a bit more of that as we go along. And don't forget, we're going to go through lots of examples of this. With bull flags, what we would do is we take profits on half of the stake that we traded when the stock moves up by 0.382 or by 50% of the initial flagpole. Now, again, I prefer the 38.2%. Now, 382 comes from a Fibonacci number. I don't live my life by Fibonacci. I think you can get into awful problems if you do. But for setting a basic profit target from a breakout of a bull flag or bear flag, or even breakouts as we're about to see in the next little while, it's a really good profit target to use, and one that seems to hit over and over again. And what I want you to do is get used to taking profits. So if we were to buy 100 shares initially, what we would do is, as that share price hits our target, either the 38.2% or the 50%, as that share price hits that target, that first profit target, we would sell half our stake, i.e. sell 50 at that level. We would then raise our stop loss to near break even, and I'll show you how to do that in a minute. And we would then use a rising trend line as our trailing stop as the stock price rises. So it means that we not only take our first profit, but we then protect the second half of the trade and make sure that we can't lose on that. And that's the key bit to the way to trade with me. And not only that, but if the stock keeps on going in our direction, we've still got half of our stake on that, and we can ride it so that we can get a windfall profit. So let's go through an example here. The stock price moves up an initial $4, forms a bull flag. We have our breakout point there, and we have our stop loss underneath the flag, or tighter if you like, as we did before. And we buy 100 shares upon the breakout. We sell 50 of those at our first profit target. And we raise our stop. See the line changing color there? We raise our stop, so we absorb a tiny amount of risk on the second half of that trade. And we can then manage the rest of the trade with a trend line that we can then adjust as the stock goes up, maybe forms more flags on the way up. So that way, what we've done is we've bought 100 shares. As it's hit our first profit target, say at the 0.382 level, we've then sold half of our stake, we've raised our stop to protect the second half of our stake, and then the second half of our stake we then manage with a trend line. And there's nothing to say that if the stock forms more flags on the way up, then you can increase your positions and buy again as it breaks out from the new flags, and that way you can keep on adding to your positions as you keep on going. So if a stock is really going to go a long way and form flags on the way, you can keep on participating over and over again with that. Now that's a wonderful market to operate in, and when we get those markets, we make lots and lots of money. Okay, so let's now revisit stop losses again and how we can tighten up our stop losses so we don't have to absorb too much risk. Let's just say that the stock price goes up but doesn't hit our profit target and starts to reverse on us. Can we adjust it? Well, yes, we've already gone through that, so let me just show you an example. Here's the stock price going up and reversing, or retracing as it were, maybe forming quite a thick flag. We've got our three lines there. Our first line, which is in yellow, is our entry point. We have our stop loss underneath that in magenta, and then we have our first profit target. Now let's just say the initial stop loss we were going to put on is underneath the base of the flag. What we can do with that is we can adjust it. We can raise it to being just below the top of the flag potentially. So that means that if the stock were to break out and not hit our profit target, it means that we can minimize our risk. And remember, it's quite possible that we get stopped out at this point here, and then the stock reverses again and starts going up again. So you pays your money and you takes your choice. If you're going to absorb more risk and have the stop loss at the base of the flag, then you'll have a bigger loss if it were to actually get there, if it were to break out and then come back down and hit that stop loss, but you will get stopped out less often. If you are going to raise that stop loss higher before the first profit target is hit, then you are going to get stopped out more often, but it's only going to be very tiny amounts.